In this example, we'll be using practice exercise 10.6a that can be found in your textbook on page 477. We will be determining the depreciation for the first year, book value, and the gain or loss on the sale of equipment, and be journalizing the sale. The exercise tells us that we purchased equipment at the beginning of the year costing $465,000. The equipment was depreciated using the straight line method based on an estimated useful life of 15 years and an estimated residual value of $45,000. Again, they want us to determine the depreciation for the first year. They want us to assume that the equipment was sold at the end of the 8th year for $235,000 and therefore determine whether there was a gain or loss on the sale, and then finally to journalize the entry to record the sale. So, for part A, we need to calculate the depreciation for the first year using the straight line method of depreciation. The formula for straight line is our initial cost minus our residual value divided by the useful life in years. So for our example, we had an initial cost of $465,000. We had an estimated residual value of $45,000 and an estimated useful life of 15 years. So again, we take our initial cost of $465,000, we subtract away the residual value of $45,000, and we will divide it by its useful life of 15 years. So based on those estimates, our depreciation per year is $28,000. In Part B, they want us to assume that the equipment was sold at the end of the 8th year for $235,000, and we need to determine whether there was a gain or loss on the sale of equipment. So the first thing that we're going to want to do is to calculate the book value of the asset at the end of that 8th year. And in order to do that, we take our initial cost of $465,000 and we subtract away our accumulated depreciation. Well, we know we've been recognizing $28,000 for the last 8 years, so we'll multiply that by 8 to get to our accumulated depreciation. So our book value, then again, the $465,000 minus our accumulated depreciation over the last 8 years. My book value is $241,000, meaning the value of this asset that's sitting on my books is $241,000. We now need to determine whether we have a gain or a loss. And we're going to do that by comparing the cash received versus the book value of the asset. They tell us that we're selling the asset for $235,000, and we just calculated the book value to be $241,000. In this case, the cash received is less than our book value, so we have a loss. So we now can calculate our loss. We take the cash that was received of the $235,000 and we subtract away the book value of $241,000. That gets us to a loss on the sale of this fixed asset of $6,000. Finally, in Part C, we need to do our journal entry for this sale. The first thing that we're going to record is the cash that we received. Cash is an asset, so we know that our cash increases with a debit. So we are receiving $235,000 in cash. We need to eliminate the asset as well as the accumulated depreciation that's associated with our asset. Accumulated depreciation is a contra asset account, which means it would have had a credit balance. If we want to eliminate that balance, we do the exact opposite and debit it. Again, we know that there was $28,000 over the last 8 years in that account, which gets us an accumulated depreciation amount of $224,000. We also know that we have a loss on the disposal of this asset. We calculated that in Part B. We had a $6,000 loss. Our loss on our disposal would be shown on our income statement, and it would reduce our overall net income just like expenses do. Therefore, it's a debit. If we had a gain on our sale, we would credit it because, again, it would be on our income statement and it would be adding to our net income, just like our revenues. And finally, we need to eliminate our asset, which in this case is our equipment. And we have to eliminate our equipment at the total value that was sitting in that asset account. And our total value is $465,000, which represents the purchase price. Remember, we always record our assets at what we pay for them. We had an offsetting account of accumulated depreciation that brought down the equipment value, but we never actually reduced our equipment account. Please remember when you're doing this, make sure you eliminate the accumulated depreciation. Do not just record a credit to equipment for the book value, in this case of $241,000. That would be incorrect because that would still leave value in our equipment account as well as value in our accumulated depreciation account. And we can see that our debits, if we add them together, right down here you see the sum, equals $465,000, which matches our credits of $465,000.